Thank you guys for joining in. This is particularly for participants who are residing in the Middle East. If you're somebody who's in India, this might not benefit you, but we will be covering a lot about ESOPs and RSUs, which will be good. And we'll also get into the framework of NEO. But for if you're from India, then it would be Sphere. It's a very similar strategy, so no change in that. I'll quickly run through the presentation so that we can have good time for Q&A. Okay, so early birds in a company's success stories are the ones who benefit the most over a long time, which means that yes, we've seen this happen. You have also been through this where you start off small in your career, you stick by the same company, and you as the company grows, you see them benefit, and in return, you go and benefit. So that's why we've taken a particular case. Let's say let's say Vijay, who's been working in a tech industry, he's had a successful career, and as he was looking for more jobs, as he progressed in his career, he's a very interesting one in a US based tech company operating in Hyderabad, but it's a US based, right? So the salary was 10% lower, but he was getting ESOPs and RSUs. And his year-end cash bonus was up to 20% of his income. Plus, he had the option to participate in the employee stock purchase plan. Right, so he is able to participate very freely. He's getting good amount of compensation. And does employment mean wealth creation? For it to mean wealth creation, you need to have a clear understanding of the deliverables and how the bonus is structured, on what basis are you getting that particular bonus, so that going forward also from your career perspective, once you meet the deliverables, for what you're going to be getting it, right? Then the stock purchase plan was structured in such a way that he would make an immediate 10% return. So you need to go to HR to say, yes, I want to understand these particular aspects of my compensation, of my bonuses, so that you're very well aware of how to make the best use of your employment, so that it actually is a part of a wealth creation. Otherwise, you're just taking the salary, you're just taking the bonus, and then doing whatever you want with it, investing, not investing, right? But you need to know how that bonus is coming, so that it can work. Once you work for the employment, that should also work for you, right? So every year, a portion of his RSUs would vest, creating an additional stream of income. So a lot of places, right, where you're able to see clear streams of income. Right. So what is this wealth creation story dependent on if you're a salaried employee? One, it's on the salary. One is a bonus. Second, to the company's performance, it is linked to the stock price and your and the investments that the company would make, which in return would make more money. Right. But it's a hand in hand. It's not separate. It takes a lot of commitment. So rather than putting all your eggs in one basket, right? Because a lot of it becomes more concentrated in terms of your ESOPs, your RSU. Diversification is definitely needed, right? So let's look at RSUs. What do you need to know about RSUs, right? Only own RSUs on vesting. Otherwise, don't look to own it. If you do have it, it reduces career mobility, right? Because your bonuses that are coming are locked in, and you can vest it only after some time. Right, there's no guaranteed return, but you can visibly see the value of your bonus and your compensation going up and down, right? Which is a very stressful part, right? There is a high risk of concentration, and it is taxed as income on vesting. Let's look at ESOPs. Now, ESOPs is an option for you to buy the stocks. There are two levels. One is the slab rate, which is the excess over the exercise price, which is the what you make on fair value, and then there is capital gains, right, which is your selling price versus the cost price. So two levels of taxation is what you're actually paying for when it comes to ESOPs, right? Now, when does the stock purchase plan make sense? Now, the 10% gain would only work if you sell immediately. Otherwise, if you look to hold it, you don't make anything. But when do you look to hold it? Right, this accumulation should happen only when it is at a cyclical low, when things are going very bad, and you participate in that plan where you're able to get more and more shares at a better valuation. So in return, when the cycle peaks out, you're making much more better returns than that of your peers. Right, but this is a very good strategy, foolproof strategy. That if you do it at a lower valuation, right? There's a question of what is RSU ESOP. See, when you work, your compensation comes from a stock option plan or a restricted stock units. Basically, these are compensations coming to you in the form of shares, right? If you're working for a company and the company is a listed company, compensation comes in these aspects where you do get to participate in the share purchase at a lower price, uh, or you get stock options and restricted stock units, right? You have the option to take, you have the option to buy, right, at a particular price. Now, making sense of ESP, how do you make sense of it? How does it work for you? Now, markets are a cycle, right? You go from extremely overconfident to extremely pessimistic, right? And you're aware of this particular chart. So your job comes only when your participation is higher during a pessimistic point, and if you are having the option to participate in your stock purchase plan, then this is where this part comes in. Better returns at a cyclical low comes in only when there is huge participation coming in during a point of fear. Now, uh, let's look at stock price and business fundamentals. Now, see, when somebody is working and you have an inside lens of how things work, you are having a biased view towards those things, right? So, for example, if you're working, and this is a live example that we faced, where it was a pharma company, that an investor was working in, and the valuations were extremely high. But from an inside lens, it looks very bullish. It looks very optimistic of what the company is doing, right? So, certain sentiment oriented movements can really impact your wealth creation. So for a short term, you would have some bit of divergence, but over the long term, there is a good convergence that comes to the fair price of the particular business. That's why we say that when your wealth is linked to share purchases, when it is linked to restricted share units, right, share purchase plan, participating at a point where things are extremely pessimistic from a sentiment point works very well in your favor, because you already have an inside lens of what is happening in the particular business, right? But understand that that bias will always come to push you either to extreme optimism or to extreme pessimism. So you have to manage that part of making sure that your emotions are not going very high or very low. It needs to be it needs to be a rational expectation of the business, right? But over a long period of time, you should take advantage of short-term divergence, so that over the long period of time, there is a good convergence that happens in fair value, which is what usually happens, right? So let's look at the tax impact. Now, in RSUs, during vesting, the market value of shares is considered as income and is taxed accordingly, right? So short term is less than 12, long term is 12.5 on gains of 1.25. For global, it is considered less than 24 months. Long term is again 12.5%. But for your ESOP, during exercise, that the difference between the fair value and the exercise price, right, the price at which you are going and saying I want to purchase it at this price from the company, and the fair value is taxed at your slab rate. So at the time of exercise, it is considered as a prerequisite where you're taxed at your slab rate, right? So that is on short term. On long term, it is again this similar 12.5%, but global ESOPs are considered, and global stocks and unlisted stocks in India are considered 2 years, and after 2 years only is considered as long term, but before that it's considered as short term. So I'll go on. So how do you de-risk for wealth creation? So this is a live example where this was for a company where we began review when things were not looking very good, right? As we staggered, it's similar to what we do from a portfolio review perspective. As there was a good increase in share value where you were able to participate much more lower than this, naturally over a period of time when the review was once we did the review, it was benefiting that particular investor. So we were de-risking and making sure that whatever wealth is locked in that concentrated position comes off, gets de-risked, and goes into other parts of the entire market, right? So our entire process goes like, we would review it first. We would see from a wealth creation standpoint how much of a risk this can be. Sometimes we do let concentration risk run, because we feel that the current valuations do not justify the fair valuation of the particular business. So we let it run. If not, then we definitely make sure that it is de-risked and it is diversified into other ideas, right? Okay. All fortune is good fortune, for it either rewards and disciplines or punishes, and is either useful or just. It's a very good quote. It's a very deep quote. And you must look at it because the entire risk of concentration is very high, and you are unaware majorly of how you are being valued in a particular company, because you just see bonus and you feel happy about it. You see the ESOPs and you get happy about it. But awareness of how you are able to generate income for the particular business and how they are able to in turn contribute to your wealth creation matters a lot. Right. So how should fortune favor someone who is having ESOPs and RSUs? One is that reward needs to go into proper strategic planning plus asset allocation. The problem only comes here is because of that high concentration, not because of anything, and the tax impact. So de-risking and asset allocation really matters for somebody who does get most of the bonuses and ESOPs and RSUs, right? Okay, so what do we do in terms of strategic planning? One is it's goal based. We prioritize certain goals, right? Because everything is going to be majorly retirement oriented, but we make sure that it's diversified and make sure that in that journey towards retirement, wealth is built more sustainably with lesser volatility, because if you have more concentration, then naturally you're going to have more volatility, and our job is to make sure that the volatility is lesser, right? Then comes asset allocation, and rebalancing of course comes during a point where we are very close to meeting that goal, or when valuations are very expensive, right? So how can somebody de-risk? One stop is having a diversified multi-asset approach. This is what Neo is about. So the next couple of slides are going to be more from a Neo framework perspective and how Neo can work for Indian investors. I work for investors earning ESOPs and RSUs that are residing globally, but as an option to invest in India, Neo is a very good one-stop solution that saves every month, avoids losses, compound regularly, invest at the right time, and invest at the right place. So what does an investor want? Investor wants to compound regularly, right? This is what Neo's promise is, where we want to grow sustainably, consistently, and make sure you have low volatility. All of this is built from that angle to make sure that you have a vehicle in which you can continuously keep saving money like a mutual fund, and it's has a better strategy than a particular mutual fund, where we are able to take advantage of investing at the right time and at the right sectors and themes, so that over a long period of time you're able to compound at higher rates with lower volatility. So what is the deciding factor for for portfolio returns? There's an online study, you can go through it. It comes more from an asset allocation standpoint. It doesn't come from timing the market. It does not come from choosing anything, but it only comes from maintaining a proper asset allocation, right? So during a particular market cycle, we make sure that for that particular investor, given their risk profile, there's a certain allocation that runs for them. It's tailor-made, but from an overall perspective, we make sure that they are in line with what the PMS strategy is. So we work with a certain set of investors, so that they are in line with the overall framework of the strategy. But asset allocation is the biggest determinant of portfolio returns between you and somebody else, right? Why is it different? It's because it's more related to asset allocation and nothing about, oh, I did this, oh, I did that. No, it's a purely asset allocation, right? And why does it work? Because it suits a wider set of audience. right? It exceeds the return expectations for moderate investors. See, because there are some cases in which you are a conservative person, but you're forced to do something like an FD, which is a low return, does not beat inflation, does not beat uh, uh, inflation, does not beat GDP expectations growth, nothing, does not beat anything, right? Hence, having a diversified approach, we are able to control risk and still deliver returns, means we are able to exceed return expectations even for a purely equity product, right? And because the ideas keep changing, cycles keep changing, this allows investors to participate continuously across all ideas. Say some cycles are more equity oriented, so equity goes. Some cycles are more debt oriented, so debt goes. Some cycles are more precious metals oriented, so precious metals goes. So you will never run out of the strategy will never run out of ideas. So you can confidently keep doing SIPs in it, knowing very well that that moderate expectation will be met, right? And it suits a wider range of risk profile. So anybody aggressive also will still be able to benefit from the strategy. Somebody who's conservative also will still be able to benefit from that particular strategy, right? Now, how does NEO work? Now, NEO's framework is that it has no cap on any particular asset class. It follows a top-down and a bottom-up approach on all asset classes. So we take a macro view and make sure that, okay, from a macro view, we need to do this given the current conditions. And from there on, choose a bottom-up approach to narrow down on what ideas we need to invest in. There is a concentrated approach towards a particular theme, not towards a particular name. So we would be overweight on a particular sector or a particular theme, which is very similar to that of what a mutual fund would do. But here, it's slightly on the aggressive front than what a mutual fund would do. Right. So how does it work? When we look at top down, we see from an active strategy standpoint, from a passive strategy standpoint. From an active strategy standpoint, you have more direct, you have more direct stocks that come into it. From a passive, it comes from a we look at it from a basket approach. There's sectoral comes, global comes, debt ETFs comes. So basically, it's more basket oriented based, right? Then comes your bottom up, right? Bottom up is purely active, where we purely look towards doing via direct equity and some amount of high quality debt papers that we're able to get, right? So when we see from a macro approach, how do we split it? If it's a top down, what strategy do we need to do? If it's bottom up, what strategy we need to do, right? So this is how NEO is structured. This is how Sphere also is structured, but for NEO, it's more from a perspective of global investors, not from Indian investors, right? So how have we done this? If you look at this particular theme called public sector, we look at it from a top down. Yes, public sector banking was going through a very tough time in India. Banking as a whole, particularly this part of banking, where NPA ratios were very high. They were not very well capped. The capital ratios were very low. So what did we say? Yes, there has to be a change that has to take place. And then we took a more passive approach rather than having a more direct approach. We took the basket and it was a sectoral ETF, right? So it took us some time to buy. So usually when we decide to invest in this particular strategy, we say you have that approach of more than 5 years plus, 7 years plus, because it takes 1.5 to 2 years for us to build a particular position, right? We might go from 5 to 7.5, 7.5 to 10% of the portfolio. So it takes a bit of time for the entire conviction to play out. And as conviction started to play out, we've had a staggered exit. So staggered in and staggered out is what we are looking to do when it comes to making money for you in this particular strategy, right? So how do we unlock this particular prosperity? Like I said, we get multiple options, right, in multiple cycles. So for example, when you have a high inflation and a high rate scenario, usually a fixed income performs. So we understand that no, this is a period where fixed income would do better. When you have a high growth and high growth coming in and earnings are growing fast and it gets re-rated, then equity starts performing, which is what you've seen before, right? But when you have a low growth and you have a dynamic strategy to move across asset categories with no cap on any particular asset class, because a mutual fund would have net 60% or net 40%, net 50% to be compulsorily invested in equity. Some cycles don't require for you to do that. At that point, using a dynamic strategy, multi-asset would do well, right? And how have we done, right? So if you see from a long-term perspective of 2 years, Neo has done much more better than your flexi cap category, which is 100% or 90% say equity, right? If you look at it from a dynamic asset fund category, if you look at it from a uh, index category, you see that we have done fair better than that. But don't see 2 years. This is just to prove that yes, we have this strategy has been working very well because our exposures have been diversified across equity, debt, precious metals, global, and hence this sort of approach works for you as an investor, right? Where you have more concentration coming in on one particular business, one particular company. When you look to diversify and take stakes in other companies, this strategy works for you very, very well, right? And if you see in terms of what's happening over 1 month, right, where the markets have been going down, Neo's fall has not been as high as what other categories fall are, because we are making sure that risk is managed by having other asset classes. So where do we operate? We operate between the conservative to moderate part, where we do take some bit of risk, but overall our general framework is to be very conservative in how much we want to pay for a particular business. Right. So our return expectations are average inflation plus 5 to 7%, depending on how the scenario pans out in the future. Right. Now, in terms of how Neo handles drawdowns, here you can see since our inception, Neo's drawdown has been 4%, right? Which is much more better than what Nifty. This is since our inception and not now. This is since our inception. Our inception has been 2021. So if you see from that particular angle, we have done much more better than the entire category by itself. So this is where your lower volatility starts coming in. Now, if you see in terms of our performance, what I want you to see is more from a asset allocation perspective. This is slightly dated, the number, but if you see from an equity part, we are 70% all on equity. Global is 4.5%. Our precious metals is a big heavy weight of 15-16%, and the rest is cash and cash equivalent. So we are taking a more diversified approach when it comes to investing in across different asset classes. Right, 2022 was Neo, 2021 was Sphere's inception. Now, minimum is 50 lakhs. We are benchmarked against the multi-asset index, and there is no exit load, but there is a fixed fee of 1.5% per annum, which is calculated on daily portfolio value. So the entire fee would be 1.5%, right, which is charged to you quarterly on the NAV, on the net asset value. So let's say a 50 becomes 70 on 70, if a 50 becomes 40 on 40, right? This is the whole team. There you see me. So we are a big team of research and strategy with fund managers. If you see Shams as the fund manager across, and we have Niranjan sir, who is the head of investment strategy. We have Rohit and Rajat, who are co-fund managers in the small cap fund. And you have Balaji sir, who is our head of research and the co-fund manager of our large cap strategy, which is True. So now I think I'll open the floor for Q&A. If there are any questions, I'm very happy to take it. So you can put your questions in the chat box. I think you've raised your hand, but you can just put your questions in the chat box or in the comment box, wherever. Yeah. Sorry. Okay, there's a question on in 2025, are you focusing more on precious metals and debt and less on equity? See, the focus is to be calibrated on equity. Yeah, the optimism is more on precious metals, but it's to have a more calibrated and tactical approach on equity. Uh, there are many options on the equity side which we can take advantage of. Apart from risk management being invested in one stock, what is the other factor that the investor needs to consider in ESOP? See, tax is a very big impact. Yeah? So you definitely need to consider tax impact for you. And see, it's not, this is a big thing. Actually, in terms of concentration, we've seen it go nearly down by 50% in 2 days, 3 days, the wealth, which it's not easy for anybody to digest that. If my money was also like stuck in that, it would be catastrophic because my goals are linked to it. So your goals are going to anyways be linked to it. The decisions that you take are going to be based on, yeah, I have a lot of bonuses there, and you take real decisions based on some value. So definitely you have to one benefit from it by actually taking the money off and making sure that your tax planning is pretty good, so that you can take that approach to diversify and at least move on to the next thing. You can just send a hi on this number. You can just tell that you're invested on Neo. I mean, you're interested in Neo, that you want to have further discussions on Neo, and somebody from the team will get in touch with you. Neo or Sphere, whatever. These two. You can just tell Neo, somebody will get in touch with you. I put down the number. You can just send us a hi, stating that I have this particular query. It's for Neo, and somebody would reach out to you. How did multi-asset generate high returns compared to your pure equity gains? No, it was in line. See, pure equity works with a different strategy. We work with a different strategy. Our strategy initially was overweight on particular parts, and that did well. Then the precious metals part did very well, right? So there has been a hedge across. So where they missed out, we've covered up. Where we missed, they've covered. So we always say it should be a basket where you can have two strategies put together, where one can be more flexi if you're depending on your risk profile. If you're aggressive, then if you're very aggressive, then a small plus multi would work. If you're not very aggressive, you're moderate, then a flexi with a multi would work. If you're conservative, then a multi and a large would work. So we always see from that aspect. But there are periods where we do well and they do well. So where we did well, they did, compared to that, they did very well. But where they were not able to catch up, we were able to catch up. It's just a cycle. Overall, you see only from this return aspect. See, this is not. I think in the morning also, when I was discussing over another topic, PMS should not be seen from a return aspect. It should be only be seen from a strategy aspect and whether it's a fit for you or not. But today, last 3 years has been uh, a whole rally where everybody is only seeing the bottom line and not actually how that money that return is derived. Right? If the backbone to derive returns is very strong, then nothing will happen. If the backbone is not strong, then you will have multiple bouts of volatility up, down, left, right, everywhere. So I would say you see the strategy. The strategy has worked. This was an RIA service that we used to do, and it has worked. So our expectation is always from a 12 to 15%, 15 to 6. That's the only uh, expectation that we work with always. What is the PMS strategy combination you suggest for aggressive risk profile? Look, I think that first you should take the risk test before you can prejudge yourself to say you are aggressive or moderate. I would suggest that let's take the risk test. Huh? It will clearly determine your ability and your willingness to take risk. Then you will get to know, what you should be doing. But I would first say that let's get to whether that profile is true or not. Let's validate that. Okay, I'll keep the floor open for another couple of minutes for more questions. If not, then we can close. Thank you so much for joining in. Uh, I think somebody is typing. Okay. Thank you so much for your time. I think I don't know further questions. So if there's something that I missed, in APMI we are seeing alpha strategy also in terms of product. Yeah, that is a product, but the ticket size is very high. So we are not. It's not something that it's a high ticket size. Okay, so done. Done. I don't think there's any further question. Thank you all. Thank you so much for your time. Have a great weekend ahead.